We are fortunate in Texas because we have had a lot of the job generators and other aspects that have allowed real estate prices, much more so on the residential side than the commercial side, but commercial has been doing well, simply because of the attraction that Texas has had. It's just the migration to Texas, taking advantage of the affordability that's down here. And then we also have just good internal growth, just the overall population growth growing. There are many factors impacting the supply side, causing the prices to rise. Obviously, the pandemic and what happened there, on top of which there were supply chain issues and the ability to get lumber and drywall and some of those things. It was further impacted by what happened with the freeze. I think the months of supply in Austin for homes available for sale has typically been between 3 to 4 months. When you go back to the spring and we had this flood of people moving into Austin, that statistic actually got down to about a week or two in terms of the homes available. And anytime you have a scarcity of a good and a lot of people wanting it, it's going to drive that price higher. Is this a bubble? Is that what's going to take place? Well, one thing that might pop the bubble is, what is the Federal Reserve going to do? Gradually, we're likely to see interest rates start to come off. So that could start to inhibit, and actually that demand then that might have gone for single family homes is going to go to the apartment market, right? Because people still need a place to live. If we step back and ask ourselves, if it had not been for the pandemic, would we all have embraced virtual learning and virtual aspects? So it's amazing of what we have accomplished. And I think that this flexibility is going to offer quite a bit. So you're going to have this de-densification. That means fewer workers per square foot, or said a different way, more square feet per worker in an office space. At the same time, leveraging some of the virtual technologies we have. But it's going to take a little while. It's going to be another year or year and a half until we get employment back to the level it was prior to COVID, to really see the occupancy rates. And of course, more vaccines, immunization rates need to go up, and all those things get people comfortable. When you look at some of the national statistics, the year-over-year income growth is up 3%. When you look at institutionally owned properties, I'm pretty optimistic about it. So the buildings are still leased. The vacancy rate is only increased by 2%. Another way of looking at it is that the occupancy rates were at about 90% nationally, and they've dropped to 88%. Well, that's the long-term average. I went back and looked at each of the last 5 or 6 recessions in the US and how long it took to go from the bottom to get back to where we were in terms of employment. And then I just averaged that of all those 5. And would you believe it that right now we are tracking right on top of the average of all those past 5 recessions in terms of recovery. So we had 152 million jobs at the peak. It fell by 22 million. 22 million unfortunately lost their jobs, went down to 130 million. We're back up to 146 million. 16 million jobs or people are back at work compared to a year ago. We're still 6 million shy, but that is tracking right on top of the average recoveries of the last 5 recessions. And if you use that as a guide, it says we'll hit those numbers once again sometime around this time or fourth quarter of next year, or into the first quarter of 2023. Yes, but I would say do your shopping, do your homework. What's good about a market like Austin or Salt Lake City, Phoenix, these are all cities that have the engines of growth with good population growth, companies moving in, young people living there. And when you have that wind at your back, if you're thinking about buying a home, you should feel more comfortable about it, that it's going to retain its value.